Hello, guys. I hope you're having a wonderful time. Once again, another episode of Bullish Banter. I hope you enjoyed the last one, and we try to make sure that we educate you. I hope you, from what we shared, I believe it added some insights to your investment plan. Other than that, my name is Jesse, joined once again by super analyst.
Hi guys, I'm not a super analyst,
Okay.
just a normal analyst.
Yeah.
So Rufas Kamau, markets analyst at FX Pesa. Happy to join the session today. Hopefully we get to share some more insights, especially with what's currently happening with the Japanese economy. We want to talk about the yield curve control, Japanese interest rates, Japanese debt, and hopefully we get to understand that and use that in our trading.
Yeah, I believe Japanese yen has been the talk of the market for the last. It usually comes up, let's say, half mid-year, because last year in June again, it was escalating to the highs, ultimate highs, and then it sort of cooled down. And then this time again, Japanese yen is basically weakening against all currency pairs. Maybe we can begin by the basics. I think it was in the 90s when they basically debased their currencies and went to the low band of interest rate. Is that part of the origin of what we are seeing or experiencing in the fluctuations within its strength and weakness relative to other currency pairs?
I would say partly yes. From what we we didn't see that. I don't think you were trading in the markets in 1991. In 1991, this is when I would say historically, Japanese interest rates were high.
Okay.
That's when they were doing 5-6%.
Yeah.
Similar to the current rates we are seeing in the UK, the current rates we are seeing in the Eurozone as well as the US. So they decided to cut interest rates in order to basically stimulate the economy. And this is when they were having the highest growth in the economy. And they wanted to stimulate more, basically by manipulating prices. So we have seen the job owning that is basically done by China. So they keep lowering the value of their currency, and then their products seem cheaper to the rest of the world. And since it's an export-based economy, then they keep on selling more and growing their local economy. Okay. So since then, they have maintained very low interest rates within the economy. And as a result, they have grown to be some of the biggest economies in the world.
The story of Japan is very interesting, from being the villain during World War II era to rebuilding a couple of islands, to rebuilding to one of the largest superpowers in the world. If you look at their portfolio, I think coming back to where we are at now, they are one of the largest holders of sovereign debts in several jurisdictions. I think US is one. They are, I think, the second largest holders of US treasuries. And you look at their population, how the economy has been built up, inclusive of the low rate which they have maintained. It's called the Kuroda Abenomics.
Abenomics. Shizo Abe.
Yeah. Is it maybe that their decision to go, contrary to the general sentiments and obviously economic principle, driving one of the driving factors to Japanese yen being weakening and therefore causing, let's say, tensions within the markets?
If we mirror this with the local picture, you know that in Kenya we have had reasonably very high interest rates. Currently, the interest rates with the Central Bank of Kenya is 10.5%. So this means that any commercial bank in the market right now is offering somewhere above 10.5, and these rates have really gone up. Some commercial banks are offering 18, even 20% on loans. So as a result of this, if you're running some business in Kenya, let's say you're trying to expand that business by taking on a loan. So when you take that loan, it's not sustainable. You cannot experience as much growth because the interest rate is taking a very big chunk of your growth. So as a result, it's very difficult to grow business. But then if you look at Japanese brands, an example, a company like Toyota, you would see that they have been able to scale worldwide because they have enjoyed this period where there is very low interest rates, and the monetary policy is basically supporting the local companies to keep on doing more exports. So by reasonably devaluing their currency, it makes their products cheaper. So a company like Toyota will be able to compete with other companies producing cars in Europe as well as the US. And that's basically the model they have used to expand the economy.
And somebody was saying, I read a tweet rather, that the Bank of Japan monopoly in financial decisions is part of the reason why we are here, whereby you notice that I know a lot of traders try to capitalize specifically on maybe GBP, JPY due to its volatility. But then again, it's erratic nature, whereby you go into the weekend knowing the fundamental support, bullish momentum, and then all of a sudden, out of nowhere, they announce they're going to get into market operations, bond buying. You are like, is it that their power has grown so much? What we were saying some time back, whereby Powell has become the center of the markets, that they need to be, let's say, their wings need to be a little bit trimmed or clipped so that they don't spook the markets every time they announce something, or something is just announced on their local newspaper, Nikkei.
I would say for Japan, the biggest challenge they're having with their currency is what we identify as the carry trade. So I'll try and dig deeper into this.
Okay.
So the fact that Japan has maintained very low interest rates. I remember, I think this was 2008 when they started cutting interest rates after the global financial
GFC
crisis. And then recently they cut those rates back to the negative side. So by holding interest rates at negative 0.1% and then implementing a yield curve control, this is basically a policy that limits the yield on the Japanese 10-year bonds. So this means that the 10-year bonds will never have a very high yield.
I think sometime in the year they set a band to 0.5.
Yes.
And then recently they became flexible to 0.1.
Yes. So initially, for the last couple of years, it was 0.25%. So they doubled that around January, February to 0.5. And then last week is when they pushed this to 1%. So this means that the 10-year bond in Japan will never yield more than 1% as long as that policy holds. So if in contrast, if you look at other economies, especially the ones that have been raising interest rates, you realize that in the US, interest rates have really gone up to 5.5%. So as we speak right now, the US is basically yielding 5.404% for the 1-year treasury. So for the 10-year treasury, it's a little bit lower. It's around 4.029%. So as you can see, there's that difference between the 10-year bond in Japan and the 10-year bond in the US. So naturally, you'll find that investors will invest more in the 10-year bond in the US and dump the 10-year yield in Japan.
The funny thing, you realize that when we talk about Japanese, Bank of Japan rather market, or doing market operations, it takes a more, technical language. But when Fed does it, we know it as the basic language. What is it? Quantitative easing. Somehow people miss that bit. And I think that printing of money from Japanese yen plays a big role in what we are experiencing in Japanese yen, whereby it could weaken all the way for like 6 months consecutive, doing negative numbers against their peers. But people call it as market operations of bond buying. But when Fed does that, we call it the normal word. Quantitative easing, printing money.
The funny thing is that the Bank of Japan is the one that introduced the concept of quantitative easing in the rest of the world.
Even the negative rates, I think the European Central Bank borrowed from them after the 2008 crisis. And that is why we are seeing them maintaining it at fairly 0 to 0.25 band at the moment, right?
For Japan, it's negative 0.1.
I'm saying for ECB.
For ECB, they were negative 0.1. But before they started raising interest rates last year. Now, coupled up with that, now that the Bank of Japan basically, I think every trader, especially investor within the bond market, would be looking at what they will do. I think there's been speculation that they will dump it, and that will definitely spook the market. Coupled up with what came out yesterday, that would be 1st of August, Fitch downgrading US credit to double A plus. I think this has been coming all along. You remember when we talked to Alican, they were saying that they have kicked the can so far in the road that there is no more road to kick it. And I know a lot of traders are still trying to digest what will that mean, given that we have had a fairly positive
GDP. We have had fairly positive, slow in inflation rate. We have had, aggressive, of course, hike in rates rate. Is it something to worry a lot of traders as we head into the NFP, which the Fed say they'll be monitoring that and the PCE and CPI?
Definitely, it's something to worry because the last time such downgrade happened was just before the global financial crisis of 2007-2008.
Yeah.
So right now that it has happened, I think it's something to be concerned about, especially when you look at the trend and the numbers.
Yeah.
So the US interest on debt is rising so fast, and it's almost hitting $1 trillion this year. And this is a reasonable percentage of the tax revenue in the US, almost approaching 25%. So this means that the debt is fast approaching unsustainable levels.
Okay.
And from a Fitch report yesterday, they're basically saying that if the US keeps on spending the way it's spending, which is deficit, then the debt will become unsustainable, and this is a risk on the credit rating of the US.
Yeah.
So that's why they had to downgrade it.
Okay.
So in real sense, there's a very strong possibility that if they actually look at the data more critically, they could have downgraded the debt rating even lower.
Yeah, I've seen the White House officials and several, even Lawrence Summers, the former Treasury Secretary, critical of the same. I think this year has had a lot of events that people forget. Several major banks actually collapsed, and they were...
Yes, it's funny. There's this regional bank called PacWest.
Yeah.
Collapsed last week, and nobody really cared of whether it collapsed or not.
Yeah, I think the financial services, despite the fact other positive news and of course Trump candidacy coming to the center stage, there are still some cracks, as you call it, which haven't really been sealed.
Yes.
And I think one asset which is clearly showing that, I think over the last couple of days, was gold, which has been now quite aggressive. I mean, it is looking to hovering around 1950s and not really showing signs of going below that, actually showing signs of going back to where it was sometime back in the 2000s price level. Now, as a trader, I know there are a lot of things to follow, and you wouldn't really be spending a lot of your time doing it. Perhaps Bloomberg is an app one must download at the moment now, given all these things which are happening, including the feature which came out late in the night past.
I think X is a better source of information. You know, like if you have a Bloomberg terminal, you're paying what? Way over $10K. And the same information is like very fast available on X.
X is former Twitter, by the way.
So I think going forward, it's time traders stop focusing more on the divergence between different technical indicators in the markets and start having a larger view where you look at the divergence between central bank policies. So the fact that we are seeing the divergence between the Bank of Japan and the Fed, then it basically shows a clear path and direction in the markets. So we have seen it happen before. I remember talking about this last year. I've been talking about this year, where whenever there is such a huge carry trade, one bond is highly lucrative and the other one is offering very low interest rates, then that potential difference will basically ensure funds are flowing in one direction.
What do you think the Japanese economy rather will be going, given all these negative sentiments? And I think there was a time, some time back, there was sort of an attempt to the Prime Minister's life, besides the other one who was actually shot, unfortunately. What do you think of the Japan economy going forward?
For the Japan economy, I think it's doing reasonably well. The Nikkei is making some good returns this year. I think it's above 18%. The key problem that the Japanese economy is experiencing right now is, one, high inflation. Inflation last month printed 3.3% year over year. So this is the 15th month that inflation has remained above the 2% target that is set by the Bank of Japan. So with consumer prices rising, it's going to eventually become a problem for the Japanese consumer and start affecting companies. But then also they have been facing the aging problem, where a majority of the population is aging and the younger generation is proportionately lower. So as a result of that, production may slow down in the near future. But as per now, the unemployment rate is really good. It's somewhere within 2.4, 2.5%. It's way lower than 3%. And with this, it means that the economy is really strong.
Given their quite aging population, as you put it, and their technological advancement, I think if you've seen how Man City arrived there for their pre-season, I think those were some sleek visual representation, and obviously they are quite advanced in tech. Don't you think maybe AI will chip in and maybe cover that labor deficiency or deficit rather?
Yeah, I think AI is a real risk for any economy out there. So I can't narrow it down to just jobs to be lost in Japan. There are so many economies that are currently trying to rationalize what may happen in the economies in the next 1, 2, 3, 4, 5 years. So from what we have seen, especially in the earnings, the earnings season that we just saw the last couple of weeks, the companies that are heavily invested in tech, they are the first to benefit. So we have seen it happen with Tesla, it happened with Meta, also happened with Amazon, Microsoft, Google. They all had better than expected earnings. So the fact that Japan is top there with their top tech companies, if there's any form of AI revolution, then they'll be also in line to benefit from that.
Now, going forward, now that you know that Japanese yen basically is weakening, and of course there are still some cracks with the downgrading of US. There will be some upsy-topsy market movement all for the next couple of weeks. How would an investor or a trader maybe position himself or herself during these times? Because fundamentals will be coming from all manner of corners. You will find maybe today Biden addresses that issue. Tomorrow, maybe it's the Secretary Yellen, I think, released a statement almost immediately that Fitch rating was done, downgrading was done. How do you plan yourself?
Going forward, I think there are like 3 clear trades. USD JPY, the pound against the yen, the euro yen. They are all like facing up. They're just screening ceiling after ceiling. So there's a clear monetary policy divergence between the central banks. So if you compare what the ECB is doing, what the Bank of England and the Fed are doing with what the Bank of Japan is doing, then it's clear interest rates are going to remain reasonably high in the Western economies. And the fact that Japan is maintaining very low interest rates, then it's a clear uptrend for the 3 currency pairs. Save for USDN, which is basically moving the opposite direction.
Because also USD is basically losing a significant value to...
No, it's because of the base currency.
I get it. Now,
what I'm seeing going forward is that these currencies will continue gaining against the yen. But then once it gets to uncomfortable levels, Japan doesn't want their currency to depreciate so much so that the Japanese people start losing faith in their currency. So at some point, the Bank of Japan is forced to defend the currency. So right now, what we are seeing is the Bank of Japan buying a lot of bonds from the open market because their debt to GDP ratio is too high.
Let's say they are printing money.
Meaning that you see the decision they made last week. It made the yields on Japanese bonds to go to a 9-year high. So as a result of that, the interest on the government bonds is rising to unsustainable levels. So the only way out is for the Bank of Japan to keep buying these bonds and removing them from the open market. But then, as a result of that, the yen keeps on depreciating as a result of speculation by traders. So at some point, if the yen loosens too much, the expected outcome is that the Bank of Japan basically dumps US bonds and then uses that to support its currency. And it will basically sell the US bonds, then use the dollars to buy the yen off the open market, and in that way defend its currency.
That creating that folks' demand on the yen and a little bit strengthening to it. I think today we are in some... policy decision making here. So now, in addition to that, I think they were also at some point. You remember when the dumping the dollar in favor of trading in your own currency was happening?
Yes.
There is also the Japanese deal, I think, with Saudi, where they were buying oil
Yes.
in Japanese yen, and they did spend a lot of yen. Is that something that will also play a role in terms of either two things? Demand for oil in the open market, and therefore the price going past $82 a barrel, and obviously a little bit of strengthening impact, given we always call it petrodollar. So,
I think it's a key transition the world is coming to accept. The way the dollar system is designed is not designed to be stable when the dollar is really strong. So the fact that the US has weaponized the dollar by strengthening it over the last 2 years, the result of that has created so many cracks in the markets. For instance, in Kenya, we have been facing a big challenge in getting dollars. And as a result of that, you can see the bilateral agreements happening between Kenya and other countries. So it's the same thing happening across board. So for any country that is struggling to get dollar reserves, then they are looking to strike deals where they transact in a different currency. So a very strong dollar is not very conducive for the global market. So that's why you are seeing a lot of countries moving away from the petrodollar system and then applying to join the BRICS.
Okay.
So while Japan is not clearly not applying to join the BRICS, when it comes to its energy sufficiency, it's looking to make more bilateral deals with the oil-producing countries, and that way it gets to secure its energy supply. So when it comes to energy, you don't have a choice. You take all the energy you can get and pay with whatever the seller is asking.
Okay. Now, going forward, and of course, forward-looking basically, we just had FOMC last week. By the time this episode is going out, it will be at least 2 weeks. Two things which I think have emerged clearly. They raised the interest rate, and they were saying they would be looking at two data points. That is the numbers report and the inflation, both from producer side and of course consumer side. With all this that is happening right now, definitely it changes the sentiment in the market from being positive and upbeat regarding the dollar and obviously the economy to worrisome. Do you think maybe before the September meeting again, there might be a change in maybe from hawkish, dovish, something like that?
I think the major highlight of the last meeting was that the Fed was very clear and straightforward. They are no longer doing forward guidance on what they will do or the indicators they will be observing. They are basically shifting to data-dependent approach. So now that the fight against inflation is almost won, the last inflation number was 3%, they want to get that to 2%. For the Fed, I think the most important highlight was that they are changing policy to data-dependent approach. So going forward, like on the next meeting in September, they'll be looking at the data they collect between July and September, and they will use that information to make a decision about monetary policy. So this creates an environment where the traders and investors in the market may have to react to every data point that comes in the market. So it's more or less like building a cocktail of data where you react to the first one, the second one, trying to understand the balance of where the Fed or what the Fed may decide. So from the data we have had so far, we had the GDP coming in at 2.6%. So that was a really strong growth for the US. Earnings were really good. And this is not consistent with what the Fed wants to see. They want to see the economy slowing down, but the economy is not slowing down. So that's bad. It basically pushes the Fed to hike interest rates. So the reaction to the GDP was that the Fed will hike interest rates. So as a result of that, we saw a stronger dollar. And then we had the second data point. I think that was on Friday. The Fed's favorite measure of inflation, the core PCE price index. So this one came in slower than expected at 3.0%. And now the Fed sees that it's winning in terms of the battle against inflation. So now that tilts the angle, basically showing that the Fed may hold interest rates. So yesterday we had the Fed member Goolsbee saying that there is a high likelihood they may not go for another rate hike. Then this week we'll be looking at the jobs report, that is the non-farm payrolls. So if the job market is hotter than expected, that is if the US created more jobs than expected in July, then that would tilt to the Fed hiking interest rates. But then if it's slower than expected, then in that case, the Fed may have to hold rates level. So we are reacting to the markets every time there's a new data point.
I think there was this interview for those who follow wealth conversations by Bloomberg, whereby David Rubenson hosted the chairman, Powell, on the Washington Economics Club. And he asked him this question, like, is it really necessary that we have the target inflation at, 2% as opposed to something like maybe 3.5 flexibility, given the economy is not the same as it was in the 1970s. We have digital currencies, we have digital jobs, we have digital economy basically, compared to the mainstream labor markets whereby people had to go to work, or the mainstream service market. And therefore, in regards to what we are seeing right now, if you've been following the continuing jobless claims, they have been coming lower than expected, which is, I think, not good. Again, an indicator, because one of the key components, or say indicators of inflation cooling down is having more people unemployed, and unfortunately that is not happening. So maybe the fundamentals of, let's say, conditioning the economy or even cooling down inflation, they may need to adjust it a little bit. So I think even as we wait for what the NFP and the CPI in the coming weeks, I think one of the key factors, like you say, as a trader, you would want to just be on the lookout for such moments. Make sure you're not really exposed too much that you can't really handle your margin, and obviously the dreaded margin call,
I think Jerome Powell has been straightforward about this. They're not changing the inflation target. They want to maintain it at 2%. So as he has explained time and again, the target is more or less psychological than having the actual number. It's more about getting the inflation expectations anchored. So the moment you're in an environment where inflation expectations are not anchored, then people start pricing in that. So if a business is expecting that inflation will be rising at a higher rate than 2%, what do? They will basically hike their products higher in order to accommodate for that potential risk. So the fact that when inflation is anchored around 2%, that creates a certain psychological environment where people are basically in this belief that prices will be stable, then they tend to act on it. So in that case, that's why he wants to maintain it at 2%. So personally, if it was my choice, I would choose 0%.
I think that's impossible. I mean, prices of goods and commodities every year need to either increase or at least to make it work, depending on how things change. I guess that's been a good conversation. I hope you have learned one or two things. We expect a lot of questions regarding this in the coming days, because JPY will, and I believe BOJ will keep on releasing statements every day. So if you do not follow any of us on X, you might want to give a follow.
I think the biggest risk going forward is the Bank of Japan intervening in the currency market to support his currency. If that doesn't happen, then the current trends prevail.
Let's see what happens in regards to that. Any closing remarks as we head out?
I would like to thank everyone that voted for us for the podcast on the APVA Awards. Also, I would like to invite our listeners to make sure you follow our pages, share the content with everyone, other traders, and people interested in the financial markets. And we really appreciate your participation as well as your feedback on all our channels.
Of course. Give us a follow at FX Pesa on Threads. Due to Meta's good performance in Q2.
Have you joined Threads?
Yeah, I've joined.
I'm not joining that.
You're not joining?
No way.
You are not boarding so far. WorldCoin, you're not joining so far. Threads.
That guy has basically abused our trust enough number of times.
Let's see how that unfolds. Other than that, I've been your host, Jesse. You can follow me, of course, on Ogola J4 on X, and I think that's enough. Share your questions. I expect a lot. Good day.
You can follow me on Twitter at Rufas KE, and my inbox is open. So if you have any questions, feedback, I'll be happy to respond.